Hello and welcome back to the channel, your go-to source for understanding the mechanics behind some of the most volatile and intriguing plays in the stock market. Today, we're diving deep into a fascinating microcap that recently hit our hard-to-borrow screener, Wearable Devices Limited, ticker symbol WLDS. We're going to break down why this stock is drawing attention, what hard-to-borrow truly means, and what potential squeeze dynamics might be at play. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Let's zoom in on WLDS. Wearable Devices Limited operates in the exciting technology and consumer electronics sector. Their innovation lies in developing a non-invasive neural input interface, allowing users to control digital devices with subtle touchless finger movements. Think about controlling your smartwatch or other electronics just by thinking about a gesture. That's the kind of cutting-edge technology they're working on, particularly with their modular development kits. Currently, WLDS has a market cap of about $6.03 million, placing it firmly in the microcap category. Looking at recent price action, WLDS shares have seen some volatility. Today, the stock is down 9.12%, and over the last 5 days, it's dipped 8.54%. However, stretching back 30 days, WLDS has actually seen a significant move, up 52.91%. Chart 30-day WLDS price chart volume-wise, today's trading at 310,100 shares is quite low compared to its 30-day average volume of nearly 2.8 million shares, meaning today's relative volume is just 0.1 times the average. What is cost to borrow and why it matters? So, what exactly does hard to borrow mean, and why should you care? When someone wants to short a stock, they first need to borrow shares from a broker. If there are very few shares available to lend out, the cost to borrow those shares known as the cost to borrow, or CTB, goes up. This CTB is an annualized interest rate that short sellers have to pay on top of any losses they might incur if the stock price rises. Highlight CTB on screen for WLDS. This is where things get interesting. Its annualized cost to borrow is an eye-popping 949.3%. Yes, you heard that right, almost 950% per year. This is an extremely high fee, indicating the demand to short WLDS is high, while the supply of shares available to borrow is very, very low. Why this stock is hard to borrow right now? WLDS has hit our hard-to-borrow screener precisely because of that staggering 949.3% CTB fee. With an estimated float of just 1.9 million shares, this is a very small pool of publicly traded shares. A small float means fewer shares are generally available for shorting. When demand to short a stock with a small float intensifies, or when existing short sellers hold on to their positions, the supply of borrowable shares can shrink dramatically, driving that CTB sky high. Our internal composite squeeze score for WLDS currently stands at 52.0 out of 100, which suggests moderate potential based on a combination of factors including this high CTB, float size, and price momentum. Squeeze mechanics explained. Now, let's talk about the mechanics of a short squeeze. Imagine a situation where many short sellers have borrowed shares of WLDS, hoping its price will fall. They're paying that nearly 950% annual fee to hold their positions. If something causes the stock price to start rising, perhaps good news for Wearable Devices Limited, increased buying interest, or simply the daily pressure of that high borrow fee, these short sellers might start to panic. To close their short positions and stop the bleeding, they have to buy back the shares they initially borrowed. Chart animation, short sellers buying back shares. This forced buying creates additional demand for the stock, which pushes the price up even further, triggering more short sellers to cover, and so on. This cascade of buying is what we call a short squeeze. It's important to remember, though, that a high CTB doesn't guarantee a squeeze. It can also signify that short sellers have strong conviction that the stock price will eventually fall, and they're willing to pay dearly to maintain their bearish bet. Dilution risk check. When evaluating a potential squeeze candidate, dilution risk is crucial. Dilution occurs when a company issues new shares, increasing the total number of shares outstanding. This typically lowers the value of existing shares and can completely offset or negate a short squeeze thesis, even if the cost to borrow is extremely high. Highlight dilution risk. No for WLDS, or check for recent dilutive SEC filings like S-1s, S-3s, or 424BS within the last 90 days found no such filings. This means there isn't an immediate, obvious risk of new shares hitting the market that could undermine a squeeze scenario. Recent reverse split watch. Another important factor for WLDS is its recent reverse stock split. Wearable Devices Limited executed a 1-for-3 reverse split on June 22, 2026, which was 44 days ago. Explain reverse split graphic. A reverse split reduces the number of shares outstanding and proportionally increases the share price. For example, if you own 300 shares at $1 each, after a 1-for-3 reverse split, you'd own 100 shares at $3 each. This often happens with microcap stocks to boost their share price and sometimes meet exchange listing requirements. Historically, many microcap stocks tend to see renewed volatility or even a price pop within about a month after a reverse split, as a reset in share price and reduced float can sometimes attract new trading interest. While this is an observed pattern in some microcaps, it is absolutely not a guarantee, and many stocks continue to decline after a reverse split. Important disclaimer: this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. So, what should you watch for with WLDS? Keep an eye on the cost to borrow fee. Any significant changes could indicate a shift in short seller sentiment or borrower supply. Also, monitor the available shares to borrow, if that data becomes public. A shrinking supply combined with persistent high CTB fees could amplify squeeze potential. Look for any catalysts related to Wearable Devices Limited's neural input interface technology or model development kits that could spark renewed buying interest. Given its microcap status and the recent reverse split, WLDS is inherently volatile. Pay attention to significant upticks in volume, especially on green days, which could signal increased buying pressure. Remember that today's volume is extremely low compared to its average. Wearable Devices Limited presents an interesting case study with its innovative technology, microcap status, and an extremely high cost to borrow. Understanding these dynamics is key to navigating the complex world of hard-to-borrow stocks and potential short squeezes. Keep your eyes on the data, always do your homework, and never trade without a clear strategy. If you found this breakdown of WLDS helpful, please hit that like button, subscribe for more in-depth analysis, and let us know in the comments what other stocks you'd like us to cover next. Thanks for watching, and we'll see you in the next video.